In the past decade, Chinese real estate giants have ventured overseas to develop property in London. The slogan, "Buy, buy, buy," briefly became their motto. Rough estimates indicate that the total investment has approached nearly 200 billion US dollars. However, reality has proven harsh as these real estate giants have met with massive losses. Country Garden. China Country Garden Group, a struggling Chinese residential builder, reported a loss of 7.1 billion US dollars in the first 6 months of 2023. Country Garden is also a central figure in China's large-scale debt default cases. On February 28, 2024, Country Garden received a liquidation application. To save itself, Country Garden had to take emergency measures, one of which was to sell assets. They began by selling overseas assets. In this wave of sell-offs, Country Garden listed its only project in the UK, Also Wharf. In 2018, Country Garden, in collaboration with a Hong Kong fund, purchased this piece of land in East London for as much as £80 million. Subsequently, Country Garden obtained planning permission and spent £450 million on development, planning to build 13 buildings. However, as the project progressed, unforeseen problems emerged one after another. One of the biggest difficulties was that during construction, the team discovered that an underground drainage pipe ran through the site, necessitating a redesign and causing the project to be delayed. Now it must be put up for sale. Additionally, the Country Garden Group faces severe financial pressure. Their debt now stands at 193.28 billion US dollars, making them a major minefield in the Chinese real estate industry. Last year, the sales of the top 30 real estate companies in China continued to decline, with Country Garden's year-on-year decline exceeding 50%. Country Garden also faces huge overseas debts, totaling 11 billion US dollars, and is unable to pay interest on time. This has destroyed the credit of this once prestigious real estate giant. To save itself, Country Garden has been selling overseas assets in Malaysia, Thailand, Australia, the United States, Indonesia, India, Hong Kong, and New Zealand. It is worth noting that Country Garden was scheduled to release its 2023 annual results on March 28th, but announced that the expected release date would be postponed until after the March 31st deadline set by regulatory authorities. In a statement, Country Garden said that the delay could lead to the suspension of trading in the company's shares in Hong Kong on April 2nd after Easter. Country Garden's share price rose 1% on March 28th, closing at 0.062 US dollars. Over the past 3 years, Country Garden's share price has fallen by 95%. R&F Group. R&F Group is another Chinese real estate giant facing debt pressure and is now fully withdrawing from London, just days after Country Garden announced its exit from the UK market. According to its annual report, R&F Group reported a net loss attributable to shareholders of $2.18 billion in 2022. In 2021, R&F Group's net profit attributable to shareholders was a loss of $2.28 billion US dollars, accumulating a total loss of $4.45 billion US dollars over 2 years. Facing liquidity pressure, R&F Group began asset disposals early on. Since March 2022, after selling the Vauxhall Square project in London to Far East Consortium for $109 million US dollars, another of R&F Group's projects in London's has been sold. This project, now named Thames City, 9 Elms Square, is located on 9 Elms Lane in southern London, with a total site area of approximately 449,000 square feet and a total saleable floor area of approximately 1.7 million square feet. The Thames City project site originally belonged to Dalian Wanda Group. In August 2017, Wanda abandoned its plan to acquire the land valued at 589 million US dollars. R&F Group, in partnership with CC Land Holdings, took over the land at a price of 553 US dollars, with each holding a 50% stake. According to an announcement by R&F Group, on April 28, 2022, its wholly owned subsidiary, Instant Glory International Limited, had signed a sale and purchase agreement with Victory Trend Holdings Limited, an investment holding company under CC Land Holdings. Under the agreement, R&F Group will sell the Thames City project, 50% equity of Instant Glory International Limited, and all benefits and rights of the sales loan, corresponding to 1.31 billion US dollars and 2.14 billion US dollars respectively. According to the unaudited management accounts of Instant Glory International, as of March 31, 2022, its unaudited net asset value was approximately 5.6 billion Hong Kong dollars, considering that the project company needs to repay the sales loan of 1.65 billion Hong Kong dollars to R&F Group. This sale will result in a loss of approximately 2.39 billion Hong Kong dollars for R&F. R&F stated that the proceeds from the sale will first be used to repay existing loans owed by its wholly owned subsidiary as the seller, and the remaining net amount will be used to repay other debts of the group and as general operating funds. In a cash-strapped situation, R&F Group has previously engaged in loss-making deals. When selling the Vauxhall Square project in March 2022, R&F expected a loss of approximately 86.8 million US dollars. R&F's remaining projects for sale in London are Croydon Project and London 1 Project, with the latter also being a comprehensive development project acquired from Wanda, representing R&F's greatest residential project investment in Europe. In 2022, as several domestic real estate giants faced debt crises, R&F initiated negotiations for the restructuring of its overseas debt and successfully extended the repayment dates for a total of 4.94 billion US dollars in overseas debts, with the London 1 project being one of the collateral projects provided by R&F. In November of the same year, R&F also successfully extended the repayment of domestic debts, totaling 13.5 billion RMB. However, despite these measures, R&F was unable to save the London 1 project. Initially, R&F had high expectations for this project, believing it was very profitable. The site is located in the prime area of West London, covering 2 acres of land. However, they did not anticipate the complexity of the situation and ended up with a hot potato. The London 1 project was originally planned to be completed in April 2024, but due to debt issues, it eventually had to be halted. In February 2022, in extreme financial difficulty, Country Garden had to sell it. Zhang Songqiao, the head of CC Land Holdings, once again became the savior of R&F. On February 6, 2024, R&F announced plans to sell all the shares of R&F International Property Investment Limited and its subsidiaries to London 1 Limited, owned by Zhang Songqiao, for $1 Hong Kong per share. This transaction involves the 19 Elms skyscraper project in London, including 2 buildings with a total of 437 private residences, 57 affordable homes, and a hotel. The project is expected to be completed in April 2024 and sold in finished form. In addition, Zhang Songqiao's London 1 Limited will also assume 3 extended US dollar bonds of R&F with a minimum principal of 800 million US dollars. According to R&F's announcement, they expect to net 4 billion US dollars from this transaction. In other words, Country Garden used the unfinished 19 Elms project as a means to transfer its US dollar debt burden to Zhang Songqiao. Due to the Bank of England's high interest rate policy, R&F finds it difficult to meet sales targets. What's worse, if the sales target cannot be achieved, R&F is likely to default because their interest is paid in kind. This is why R&F is eager to complete the transaction. Wanda Group. Now let's talk about Wanda Group, and specifically the London 1 project that started over a decade ago. It was Wanda's first overseas property project, purchased in June 2013 for $11,048 from Green Property in Ireland for renovation of old buildings. At that time, Wanda's chairman, Wang Jianlin, remarked that land prices in London were much cheaper than in Beijing, and expected profits were equivalent to the value of a hotel. Moreover, London is a financial free port with plenty of room for maneuver. Wang Jianlin also set a goal for Wanda Group to have overseas business account for over 20% by 2020, with London being the first stop for Wanda's expansion. However, due to significant conflicts between the building plan and the local government and civil organizations, construction progress has been challenging, and construction companies changed many times. Then, in June 2017, the China Banking Regulatory Commission suddenly investigated overseas mergers and acquisition risks, with Wanda being a key focus. In July of the same year, Standard & Poor's, one of the 3 major international rating agencies, placed Wanda on a negative watch list, further undermining confidence in Wanda. In August of the same year, Wanda prepared to pass this hot potato to R&F Group. However, troubles continued. In September 2017, the S&P 500 once again downgraded Wanda, believing that Wanda's sale of commercial assets to R&F Group harmed the company's stability. Subsequently, the UK also issued new regulations explicitly restricting overseas investment activities in real estate, hotels, cinemas, entertainment, and sports clubs. On the surface, buying for $11,048 and selling for £590 million leaves huge profit margins. However, in reality, multiple changes in contractors, changes in blueprints, various cumbersome administrative procedures, and operating costs have greatly compressed Wanda's profit margins. In simple terms, what seemed like a profitable project actually resulted in a loss. Greenland Holdings. Like other Chinese real estate companies such as Country Garden, Wanda, and R&F Group, Greenland Holdings also harbored ambitions in the UK market and expanding its business territory, but the results did not meet expectations. In 2014, Greenland Holdings acquired the Ram Brewery site in the traditional residential area of Wandsworth in southwest London for £140 million. It planned to redevelop it into Ram Quarter with 3 phases of development, including over 700 residences and 9,000 square meters dedicated to beer. The total investment was expected to exceed £600 million. At the same time, the group also spent £100 million to purchase the Spire site in Canary Wharf, East London. However, due to over-diversification of investments leading to insufficient funds, Greenland Holdings eventually had to sell the unfinished Ram Quarter project to the UK's Berkeley Group at a low price of around £40 million. This decision marked Greenland's official withdrawal from the future development of the Ram Quarter project. Although the first phase had been completed and handed over, considering the early development costs and the potential future value of the site, it is estimated that Greenland lost nearly £500 million. Chongqing Group. Established in 1990, Chongqing Group, a comprehensive investment enterprise, also suffered losses in the UK, totaling $9.39 million. It was reported that Shenzhen Chongqing Group admitted to having periodic cash problems as early as 2023. Its chairman, Cheng Hongtian, is a Hong Kong tycoon worth $30 billion. It was revealed that he mortgaged Chongqing Group and auctioned off several properties. These properties, since being taken over by banks in March, have not been released from mortgage, further worrying the market about Chongqing Group's cash flow situation. Chongqing Group's main investment is in real estate, including Chongqing Center, Chongqing Shopping Mall, and Chongqing Hotel in Shenzhen, 20 Canada Square in London, and the new financial center in Canary Wharf, London. However, most of these real estate investments are currently on the shelf. In 2017, Chen Hongtian successfully acquired 20 London Square for $515 million, defeating competitors such as Saudi Consortium, Cedar Capital, and HSBC's Alternative Investment Department, renaming it Chongqing Center. Subsequently, Chongqing Group purchased Churchill Plaza 5 in Canary Wharf for $339 million and borrowed from Lloyds Bank in the UK. At the time, in a low-interest rate environment, Chongqing Group was optimistic that rental income could cover interest. However, with Brexit, the global outbreak of the COVID-19 pandemic, and domestic restrictions on overseas investments, the London commercial property market was severely affected. By the end of last year, the vacancy rate had reached 21.9%, with rental levels and market values plummeting by more than half compared to the peak in 2017. The increase in vacancy rates led to a decrease in rental income, coupled with interest rate hikes and valuation adjustments due to macroeconomic changes, forcing Chongqing Group to abandon its investments in the UK. According to market reports, 20 Canada Square still owes $275 million in loans, but creditors sold it for $314 million, meaning the property has become a negative asset. It is estimated that the final transaction price for the property may be only around $250 million, depreciating by more than 50% from Chongqing's original purchase price. As for Churchill 5, in April 2023, due to the expiration of its mortgage loan and failure to repay, Lloyds Bank also listed the property for sale at a mortgage loan value of $219 million, meaning Chongqing Group's real estate investment project will incur a loss of at least $120 million. KWG Group. KWG Group Holdings, listed on the main board of the Hong Kong Stock Exchange in 2007, invested in London properties around 2017. That was a time of explosive Chinese investment in the UK. However, since 2022, KWG Group has sold assets several times. In 2017, KWG Group's founder, largest shareholder and chairman, Kong Jianmin, went to London for the first time, buying 65 Fleet Street, Whitefriars in the old CBD of London for a high price of £160 million, with the idea of turning it into a pearl of the financial city. But with continuous rate hikes from the Bank of England, coupled with global economic uncertainties, the London property market became exceptionally sluggish in 2023, with the office vacancy rate in London reaching a historic high. As office utilization rates declined, some tenants chose not to renew their leases, and Chairman Kong's expected rental income fell short of expectations. In September 2023, the American financial group Jefferies stated in a report that the office vacancy rate in the old CBD of London had reached 10%, climbing to the highest level in 30 years. A classic example is WeWork's sale of the London 51 Eastcheap office building for £70 million. In the same year, despite having spent a large amount on extensive renovations, resulting in a 44% drop in the final listing price. KWG Group found itself in a dilemma of internal and external troubles. In 2022, KWG Group barely managed to repay its maturing debt of 11.3 billion RMB and completed a $1.6 billion overseas debt exchange offer. However, faced with over 20 billion RMB of maturing debt in 2023, it was still in a tight spot. In the face of such a situation, KWG had to make a difficult choice. After numerous deliberations, in December 2023, the company finally decided to sell the Whitefriars office building for just over $100 million, nearly a 50% discount, to the UK real estate company Dominus. Before that, KWG had started selling its overseas assets in September, including the office building at 65 Fleet Street in the central Holborn area of London. It is reported that KWG's development investment in the UK, plus construction costs, directly lost at least $10.38 million. Many Chinese developers have set their sights on London, entering the market with confidence, but very few have been able to deliver projects. While there have been many successful cases, the overseas acquisitions of many Chinese real estate companies have ended in financial and real estate double losses, indicating that cross-border investment is not easy. Especially with the bursting of the Chinese real estate market bubble, Chinese real estate companies have been shrinking their operations, selling off assets to deal with debt crises, and even having to seek buyers for their overseas quality assets. This selling of overseas assets has caused concern in the relevant overseas industries, fearing that Chinese real estate companies selling assets could impact real estate investments and prices in relevant countries. According to Bloomberg, Chinese real estate assets purchased during the past decade's expansion are starting to be sold to alleviate debt pressures. A subsidiary of China's Agile Group is implementing a $6 billion debt restructuring plan, selling a piece of land in Toronto last year for less than 45% of the purchase price in 2012. However, Bloomberg also pointed out that because the number of assets Chinese companies are selling is limited and price data is incomplete, market evaluators find it difficult to accurately assess the impact of the decline of the Chinese real estate market on overseas markets. Overseas regulatory agencies and markets are concerned that this situation may obscure the spillover effects of China's real estate crisis, making it more difficult for banks to lend. The European Central Bank is concerned that banks in the European region may not be able to timely understand changes in loan values and take corresponding measures. The UK Financial Conduct Authority, FCA, is preparing to review valuations of private markets, including real estate. The American investment bank Goldman Sachs warned its clients that China's real estate market is still deteriorating, and the time for its rebound remains distant. According to Goldman's estimate, China's real housing prices fell by 16% between 2021 and 2023. But based on the U.S. experience, the price adjustment in this round of China's real estate downturn is still ongoing.